In November 2024, a Nevada company called Aqua Metals traded at the equivalent of $39 per share. By May 2026, the same share was worth $5.32. That is not a bad quarter, not a bad year. That is 10 years of promises, 2 emergency reverse stock splits, and a balance sheet that has never once shown a dollar of revenue. The question worth asking is not whether this company failed. The question is whether it is about to succeed and why anyone is still watching. Aqua Metals was founded in 2014 in Reno, Nevada, with a specific idea: replace the furnaces and toxic chemicals used in battery recycling with electrochemistry. The technology is called AquaRefining. Instead of melting batteries at high temperatures, which produces toxic emissions and requires enormous energy, the process uses electrical current to extract metals from solution. The result, in theory, is purer metals, lower costs, and far less environmental damage. The original business was lead-acid batteries, the kind in ordinary cars. The company built a facility in McCarran, Nevada called Sierra Arc and spent years trying to make it work commercially. It did not work. In 2023, management pivoted toward lithium-ion batteries, the kind that power electric vehicles. The addressable market is different by an order of magnitude. Analysts project the global lithium-ion battery recycling market at between $23 and $35 billion by 2030. The technology is the same. The target is bigger. The revenue is still zero. For 5 consecutive quarters, Aqua Metals reported zero revenue, not declining revenue, not revenue below expectations. Zero. The company burns through roughly $10.4 million per year in operating cash. At the end of Q4 2025, it held $10.8 million in cash, meaning at the current burn rate, it has approximately 12 months of runway left. That cash did not arrive through operations. In October 2025, the company raised $13 million through a registered direct offering, selling new shares to investors at $11.34 each, with warrants attached. This is the 4th time in 2 years that Aqua Metals has gone back to the market for money. Each time, existing shareholders were diluted. The numbers on dilution are stark. In November 2024, the company did a 1-for-20 reverse split to stay listed on Nasdaq. In August 2025, it did another 1-for-10. Combined, that is a 1-for-200 effective dilution over 12 months. A shareholder who held 200 shares in early 2024 holds the equivalent of 1 share today. In July 2025, Nasdaq sent Aqua Metals a delisting notice. The share price had traded below $1 for 30 consecutive trading days. Under exchange rules, that triggers a formal warning. The company had 180 days to fix it or face removal from the exchange entirely. The fix was the second reverse split. After consolidating 10 shares into one, the price recovered above the threshold. Nasdaq accepted this, but it attached a condition. The company is now under mandatory panel monitoring until September 4, 2026. If the share price falls below $1 again before that date, there is no appeal process. Delisting becomes automatic. In February 2026, Aqua Metals announced something unexpected. The company signed a term sheet to acquire Lion Energy LLC, a Utah-based manufacturer of battery energy storage systems. The deal structure involves $4.1 million in cash, plus $25.8 million in stock, plus an earnout of up to $65 million if Lion Energy achieves more than $55 million in revenue within 12 months of closing. The total consideration could reach $94.9 million. For a company with a market cap of $17.8 million, this is not an acquisition. It is a transformation. There is one problem. The original deadline for signing the definitive agreement was March 31st, 2026. That date has passed. As of this recording, no closing announcement has been made. The status of the deal is unknown. Institutional ownership in AQMS is minimal. 40 institutions hold positions, but most of those positions are worth less than $300,000. Vanguard owns 26,000 shares. T. Rowe Price owns 15,000. These are not conviction bets. They are index-related positions that arrive automatically. Insiders hold 10.62% of the company. In December 2024, they bought $850,000 worth of secured notes paying 20% annual interest. Debt, not equity. One new board member came in with a $400,000 note position and a separate $3 million loan to the company through his investment firm. A director who is also a creditor has interests that do not always align with ordinary shareholders. The bear case for Aqua Metals is straightforward. The company has not generated revenue in 10 years. It has raised money repeatedly, diluting shareholders each time. Its main asset has never been validated at commercial scale. Its largest announced catalyst missed its own deadline, and it sits under Nasdaq monitoring with a cash position that runs out in roughly 12 months. The bull case requires believing several things simultaneously: that the Lion Energy deal closes, that Lion Energy's revenue is real and growing, that AquaRefining eventually finds commercial application, that the EV battery recycling market expands as projected. One analyst covers this stock. The target price is $12, 125% above the current price. Aqua Metals has a real technology and a real market opportunity. It has never turned either into money. The next 12 months will determine whether the Lion Energy acquisition closes, whether Nasdaq compliance holds, and whether the company can raise its next round without destroying what is left of shareholder value. There is a version of this story where it works. There is also a version where it does not. This is not a recommendation to buy or sell. This is a look at what the numbers say and what they do not. If you want to follow what happens next, subscribe. The next update on AQMS will come when there is something definitive to report. If this was useful, hit the like button and subscribe. New video every week. Next up, we go bigger. See you then.